even in a bad market, not every day is going to be red, okay? Because there's always buyers, all right? There's always buyers. That's why the market always goes back up. It's just people trying to time the bottom. Some people time it, some people don't. It's always going to be buyers. But when people are investing in the stock market, okay, like for example, 401k and IRA contributions, people got to max out their $6,000 on their IRA or their 401k. They have to max out, right, every year. A lot of people forget that people are buying stocks, right? Because you want to max out your IRA. So a lot of people are like, why are people buying here? Well, when do people think that they are going to, when do people think that they are going to catch the bottom, or where are they going to buy a good value of something? Okay. So you have buyers there. But more importantly, the stock market, people that are buying for their IRA and whatnot are looking 20 plus years down the road. Some investments, and you can look into the bond market for this, are 10 years down the road, 5 years down the road, etc. So it's all about down the road. So do we think that we're seeing economic indicators that say, hey, 5 years from now, we're going to be okay? If the answer is yes, based on what's about to happen, then you buy. Is there a recession coming? Well, we know a recession's coming. Like even if they fudge the numbers, we know a recession's coming. We already had one negative GDP report. And I don't see, unless it's total lies, which could happen, the next quarter we're going to have another negative report, which by definition, 2 quarters in a row of reverse GDP growth is a recession, right? So now the question becomes, how long will that recession last? Well, we don't know, but we can kind of get an idea of things that can happen based on millions and millions of little pieces of data to say, okay, will this be a short-term recession? Will this be a long-term recession? Will this help, inflation in the short term versus avoid us from stagflation? Do we have to factor in supply chains? Do we have to factor in the Ukrainian-Russian conflict? There's a lot. It's not an easy answer. But in this case, originally we were seeing a 50 basis point expectation, right? They're going to raise another 50 basis point. Every single one for the next 7, right? So 7 FOMC meetings in a row at 50 basis point would put us at 3.5% federal funds rate by end of year. And a lot of people were saying, well, at 3.5%, that's high, but it's not too high. It's enough, though, to kind of curb demand. Now, the Fed can't affect supply and supply chains, but they can affect demand by making money more expensive. All right, that was the original thing. On top of that, it's actually going to be about 4.5% because you have 1% of what's called a shadow rate increase. I just made that up, but it sounded good. SRI. Fucking lock it in, boys. That's right. We just created a new acronym and a new saying right here, right now. You were here. And what I mean by the shadow rate increase is balance sheet clearing. I know a lot of you guys are lost right now. Don't worry. I'm going to explain it like you're a golden retriever. The balance sheet was at $6 trillion prior to COVID. They added $3 trillion onto the balance sheet. So basically, they're buying up all this debt. They're getting all these IOUs. Like, all right, give me your treasuries, give me your mortgage-backed securities. I'll hang on to them, and I'll give you money in return. By clearing that at $90 billion a month, you're talking about 3 years to get us back to even. And that adds to kind of like a rate increase, because rate increases, tighten up liquidity, right? Tighten up the amount of cash flow in the market. And by calling in your loans, you're also doing the same thing. You're taking money out of the market, right? You're drying up liquidity. So it's kind of like a rate increase as well. So everybody was expecting the 50 basis points because we were expecting, hey, the Fed was like, hey, we're going to wait to raise rates until we get a better understanding. We're going to wait. Inflation's transitory. Well, it wasn't transitory. It kept going and going and going and going. So they retired the word transitory and they said, all right, we're going to keep an eye and see if it peaks. Well, the last report came in lower. So everybody's like, yay, we peaked, we're good. And then the newest report came in and said, no, we didn't peak. Not only did we not peak, it's increasing more, and it's increasing household consumer spending because the biggest increases are food, 12% year over year, highest since Jimmy Carter was in office. Energy, 36.5% year over year, highest since 2005. And shelter, rent is $2,000 per month average rent in America, and houses are now at $420,000 average. So everybody said, oh shit, 3 days ago, there was a 5% chance that they were going to raise it by 75 basis points. Now it's at 90% in 3 days, from 5% to 90%. And so people were like, oh shit, We're about to have a lot less liquidity in the market, meaning there's going to be a lot less buyers, meaning there's going to be a lot more tightened spending, meaning equities and companies are going to have to take a hit, meaning earnings are going to be down, margins are going to be down. Fuck it, let's sell these things while we have a profit but while we have a small loss. And we saw the market fucking plunge on Monday. Now, a lot of that was retail, but regardless. And now there's some out there saying, well, we might see a 100 basis point increase today. But if this sell-off happened with the belief that a 75 basis point increase was coming, well, now the market's kind of like, okay, we've sold off what we think the effect is going to be. So now they're saying, okay, now the market's where we think it'll be with a 75 basis increase. If they come out with 100, we could probably see a huge drop to the downside because we got to go to a recession. The Fed doesn't have a choice. They have to put us in a recession. If they come in at a 50 basis point, we'll probably fucking moon. And you're saying to yourself, but Saki, that just kicks the can down the road. The question is now that we are expecting 75 basis points, what is the language they use? And that's what everybody's worrying about right now. So there's so much, and that's why a lot of times we see crazy market reactions, right? Like the trend has always been, we moon the first two candles and then we dive, or we fall the first two candles and we moon. But 3 out of the last 4 FOMC meetings, we actually saw the market gap up and finish almost 1% higher than when the Fed announcement happened. So there's so much going on right now. And for a lot of you guys in here, you're like, Stocky, this is all great and all, but I don't understand a fucking thing you're saying. I don't trade stocks. I don't know what the fuck's going on. I just want to know, am I losing my goddamn job next year? Well, I don't know. It depends on what you work in. Okay? And that's why how long the recession lasts and where it hits the hardest is the most important thing. We have to go into a recession. It's either recession or stagflation. And this is a lot easier to recover from than this is. Number one. And number two, a recession doesn't always have to last forever. It's a big, scary R word. But a recession can last 1 quarter, can last 1 decade. What industries are most likely to lose their jobs? I'll tell you the same thing I told somebody very close to me who's looking for a job. He was talking to me and he said, hey, Stocky. Well, he called me Jason. And he goes, hey, Jason. He's like, I'm really worried about this recession that's going on. I don't really understand it. And he says, but I'm wondering if I should stay at my job or if I should look for another job. And I said, if I was in your position and I was looking at companies that were offering me something, I would do what I do, and that's look at the company's financials. Because if the company you're going to, let's say it's Microsoft or it's, Coinbase, I don't know, fucking a bunch of crazy. They're laying off like crazy, whatever. It doesn't matter. Amazon, whoever. You work in tech and software development. Look at the company's financials right now. It's publicly available. Does the company have what's called cash on hand? Look in their earnings reports the last couple quarters. Do they have a lot of cash on hand, and do they have a lot of debt? If they have a lot of cash on hand, they're more likely to weather the storm, meaning they're less likely to do layoffs. If they're a company who doesn't have a lot of cash on hand, has a lot of negative assets, and did a lot of spending, which was smart 2 years ago, but right now, they're going to have to cut costs. And the first place they cut costs are labor. And a lot of people don't understand how stocks and the stock market can tie into their employment. Now, that's not a 100% guarantee, but I can tell you right now, if a company took out a whole bunch of cheap money 2 years ago and spent that on acquisitions of other companies, or they took hired a bunch of new people, or they did a lot of expansions, or they did a lot of other stuff like that, and they have low cash on hands, especially debt to cash ratio, they're probably more in danger of either not surviving or making drastic cuts. But if you had a company that took all that cash and did buybacks and then maybe did an offering or whatever. Like a lot of companies over the past 6 months have been doing offerings and they've been falling, and people are like, oh my God, it's so bad. No, some of those companies are smart. They're doing stock offerings now to shore up capital so that way they can survive through the recession. And then when it's over and all their competition is either dead or, is limping along, they either rebound or buy up their competition for pennies on the dollar. It's happened every recession. Happened after the 2001 .com bubble. Happened after the 2008 recession. It'll happen again. Not a guarantee, but it'll help you. So if you're deciding between company A and company B, and they're both offering you almost the same package and everything's great, and you don't know, and you jump into company financials, and company A is, is down, I don't know, debt to cash on hand ratio is down 25% year over year, and these guys are plus 5% year over year. I mean, and there's nothing else besides them. I would definitely go with the guys who have a little bit more cash on hand. You know what I mean? Like, the chances of you getting laid off are a little bit less. And I also told him that depending on what position you're in right now at your company, you could be in danger of losing your job, because if they feel like there's somebody who's cheaper than you who can do your job, you're gone. Well, aren't they always going to kick out the new people first? Not necessarily. If they don't have to pay a severance package, they're going to dump your ass, because you've been with them so long that you cost them a lot more money. And if they really feel like somebody else at the company can do your job for a cheaper price, you're gone. What's a good cash to debt ratio? There's no formula for that, because sometimes people have less cash on hand because they reinvested their money into stock buybacks and whatever. But look at the debt they have on hand and negative asset flow as well. You're all doom and gloom. What about I'm all doom and gloom? I'm doom and gloom? The guy who's screaming at you to not liquidate your fucking portfolios, to hang through, to keep buying, and you're going to be rich one day by doing this, and that's doom and gloom? I think you're just not used to somebody telling you the way things really are. I'm not going to lie to you, baby. The only time I'll lie to you is if I'm trying to have sex with you.